Options polarity trading, buying calls and puts for quick directional trades, is arguably one of the best ways to trade. Now, why is it arguably one of the best ways to trade? I'm sure you've heard of all sorts of different contraptions out there. There are a lot of folks talking about combination strategies on options, credit spreads, condors, butterflies, and all of those complicated things. Now, those have their own benefits, but they have their own risks too. And ultimately, when it comes down to the end game, when you can get yourself in a lot of trouble and wipe your entire account out through selling options, even in combination, right? Like a credit spread. If you're, let's just say, for example, you expire between your strikes, what happens? You can go ask your broker what happens. It's not going to be pretty. And when you're trading credit spreads, the thing is, you usually tend to put on a little bit extra of a position size. And when you do so, now you're in a tremendous over leverage risk if you get into one of those nasty scenarios where you expire between the strikes. Now, why would you do that? Well, you want to make some money worth your time, right? And you're taking in limited risk or limited reward. Now, you can play credit spreads in an intelligent way, but and you can say, well, I'll be there by expiration to make sure it goes well, but will you? How can you guarantee you're going to be there? Okay. Now, you can set contingent orders to get you out by time. So there are ways to fix this, at least prevent it mostly. And you can talk to your broker about that. But ultimately, I would say in terms of risk to reward ratios, properly positioned buying calls and buying puts in coordination with a price chart is the best way to go, because you can have unlimited potential profit. Now, unlimited profit is relative to the type of move you're playing on a price chart. Now, if you buy a lot of time out into the future, that's one scenario. If you're going to buy 2 weeks out to expiration, well, that's another scenario. And you have to play a different type of price scenario on a price chart. What are these scenarios? Well, if you're trading a quick expiration, you need something that can move quick and fast and pop fast with good velocity. What's a velocity? A swing velocity. What's a swing? It's usually, you can say, a 2 to 5 day price move, but it's not just a day. It's not just that. A swing is based on price action, so it could be 2 to 5 minutes from now. So it's really 2 to 5 bars. And so, therefore, if you can line yourself up with one of these scenarios, could be on a micro swing level with 60-minute bars, you can coordinate a short-term option with a price chart event and then score, take the money and run. And you don't want to sit too long in a short-term options trade, because why? You have rapid premium decay, and plus you have expiration coming up. Your most rapid premium decay happens in your last 2 weeks. You can say last 30 days, but the last week is the most rapid, and you lose the most premium. Now, you can counter that by going in the money. And so you can find a nice balance between your in the money and your time to expiration. And when you go in the money and you have a high percentage winning trading setup, well, then you can grab a lot of cash fast because you have high deltas because you were in the money. You can ride a move quick and get out. So you can play and coordinate to the charts with your time to expiration. So you're playing options at different times with different expirations doesn't matter that much once you understand price action and coordinating with it. Then you find your optimal options position. Now, if you're going out further in time, let's say you're looking to ride some sort of medium-term trend. Maybe it could last 6 months. So the concept is that it's going to move a lot more points. Well, you need to, of course, buy options that can accommodate that. But you'll have to also ask and look at your position, whether it's going to pay you out versus the time it's going to take to develop. Would you be better off simply playing a couple swings instead? A few swings with better deltas on your options, because when you go out further in time, your deltas slow down because there's more premium puff. On the other hand, your premium decay rate it gets very slow, and that's nice. So your cost of holding the option becomes cheaper and cheaper as you go out in time. I mean, cost of holding an option, for example, for a month, all right, for 2 months. Now, of course, over 6 months, it's going to have its certain decay, but the concept is you're riding a specific type of trend move that can make up for that move. Now, if you're looking for a method, a solution for looking to buy calls and puts for quick directional trades, then I want you to go to optionstradingauthority.com or slingshotoptions.com. We have other sites as well. It's for vanilla options. We have binary options too, binaryoptionsauthority.com, etc., etc. But in order to trade vanilla options, the stable, solid, super, never-ending sort of opportunity world of vanilla options, so there's stock options, go to Options Trading Authority. You want to look at stock and slingshot options too. You want to look at quick directional. That means swing. That means micro swing. And you want to check out those types of systems there. And which probably, well, we have a lot of new systems, so I can't say what we'll have by the time you see the site. But you want to go check out the sites for a solution if you're looking to find a way just to get started right away. And in line with the polarity concept I'll bring up here, Stackers 3.0 for velocity and to trade the polarity concept. And you'll want to check this system out. It's a decent frequency, high probability, very solid approach to trading. We use the polarity concept to help us get a seriously strong edge towards achieving our profit goals. And so we have very solid performance results, as you see here. These are based on the system's rules. Okay, so those are those results. So anyways, you can check that out too. I'm just trying to get you some ideas if you want to pursue getting started now. But in short, I want to emphasize the point of risk to reward. And if you get your trade setups down pat, where they have a certain frequency of winning, and you personally have a certain frequency of learning, of winning in those trades, and then where each trade you do, if you put them all together, they average out to a certain amount of profit in your options, not just the stock, because you have to equate premium decay and such, right? So when you can combine those two factors in coordination with a money management position size, then you put yourself in position to win and make money and net out profit over time. Granted, the system is, and you are performing the system in a consistent way. So ultimately, if you turn trading more into a professional type of deal, a professional, you can say trade as a business, turn it into a real business and do your homework, do the math, do the logical things. Don't base your trading off of emotional whims. Then you can put yourself in that position to have and run the greatest business opportunity on the planet. But unfortunately, most people do not trading seriously enough, and they don't succeed. But that's fine. they can keep funding your account as you learn to trade professionally. And if they want to keep donating money to the market because they're not willing to simply learn to trade well, which doesn't take that much learning compared to anything else, any other profession, then that's fine. Let them do it. And you, though, become a professional person who does their homework and learns what it takes and does the right thing. Put yourself in the position to succeed. And in the markets, you have tremendous opportunity for cash flow and lifestyle. But let's just move on. Thanks.